Tony Bedikian, the S&P is up 10% in the past month. It's finally positive year to date. So are your banking clients looking to add risk or decrease it from here on out?
You know, our clients, Greg, in general are very optimistic about their businesses in the fourth quarter and into 2016.
All right, well, what are some of the takeaways from the third quarter earnings period? We're not quite through it, but we're on the back half. What are you hearing that you think is real important?
Well, you know, I think in general, the earnings season was a little bit mixed, but came in, I think in general positive. Our clients are focusing on the fourth quarter and into 2016, and their businesses are performing in general quite well from what we are seeing. And they're also looking to mitigate risk in certain sectors, particularly on their interest rate risk management and their currency risk management side.
Well, let's talk a little bit about currencies, because that was one of the things I heard a lot of from the industrials during earnings season. They got hit by that stronger dollar. So how are you helping your clients deal with that?
Well, we offer products in the foreign exchange market to hedge against the rising dollar. We have clients that have exposure to currencies globally, essentially. So we have clients that are looking to repatriate funds from Europe, from Asia, from multiple countries around the world. So we offer foreign exchange products that help them reduce that risk.
And do you expect the dollar to get much stronger? Is it going to get worse?
Well, it's a great question, Greg. I think it's going to be an interest rate differential story. So obviously the Fed's next move is anticipated to be a hike. We don't know exactly when that will happen yet. We've got foreign central banks in Europe in particular, the ECB and the Bank of England. We also have the China story where they're easing. We just had a 25 basis point ease and also a currency devaluation back in August. So we have kind of that disparity in both rates and in economies, U.S. versus global, and that in general is a dollar strengthening story.
So how hard is it to plan? Because at the start of 2015, everyone said that the 10-year yield is going to go from 2% to 3% or 2.75%, but we're still stuck at 2%. So you can give me your outlook for 2016, but most of all, tell me how you plan for this.
Yeah, it's another great question, Greg. As you mentioned, the 10-year note has had a relatively wide range, down to roughly 165 and then north of well north of 2.25 this year, where we keep ending up around 2% or so. A lot of this is going to be based on expectations of Fed tightening. Back in September, we had the market had anticipated potentially a Fed hike. We didn't get that. We have a Fed meeting tomorrow. The market's all but priced out a Fed tightening. Going forward, we have roughly 7 weeks left of data before the Fed's meeting in December, with 2 payroll numbers to go. So all eyes will be on the U.S. payroll numbers going forward.
All right. The other thing we've seen recently is spread widening on high yield. Any view on high yield with the lenders, with your clients? The people you lend to? Sure.
Not in particular. Our focus is on the middle market clients, and so they're focused particularly on their businesses. So, I think any widening that we're necessarily seeing in the high yield markets, it doesn't have a significant impact on our particular client base necessarily. Our clients are still looking to borrow money and expand going forward.
All right. Well, thanks a lot, Tony.
You're welcome. Thanks, Greg. Thanks for having me.
Thank you for watching The Street.